Hello friends, I am Dr. Ashutosh Agarwal from ITARC College of Management, affiliated with Dr. APJ Abdul Kalam Technical University, Lucknow. Today, here I am giving a lecture on Markowitz theory under selection of portfolio, which covered under the subject of investment analysis and portfolio management. KMB FM 01 consists of second unit, and this is our second unit, lecture 6, Markowitz theory. Any asset of portfolio can be described by two characteristics: the expected return and the risk measure. The portfolio variance is a function of not only the variance of return on the individual investment in the portfolio, but also of the covariance between returns of these individual investments. In a large portfolio, the covariances are much more important determinants of the total portfolio variance than the variance of individual investments. So, the variances of total portfolio is much more important to calculate the variance of individual stock. The Markowitz has given few of the assumptions where investors consider investment as the probability distribution of expected return over a holding period. Investors seek to maximize the expected utility. This concept, this theory, Markowitz theory, is based on the utility concept, utility of a particular investment. The investor measure portfolio risk on the basis of expected return, variability, that is called as the variance of return, and investor make decision only on the basis of expected risk and return. For a given level of risk, investor prefer higher returns to lower returns, and for a given level of return, investor prefer lower risk to higher risk. In short, the investor prefer the lower risk and higher return always. Means investor prefer to invest in those securities which goes from lower return, higher return to lower return, and comes from lower risk to higher risk. There is a utility function and indifference curve approach used under the Markowitz theory. Utility is the expected return minus the risk penalty, where the risk penalty depends on the portfolio risk and investor risk tolerance capacity. The utility of a particular investment is depend on the expected return and the risk penalty, where risk penalty is equal to the variance divided by the risk tolerance. Risk tolerance varies from 0 to 100, where risk penalty is less as tolerance increases. If the tolerance increases, then the risk penalty will become low, and as low as the risk penalty, as high as the utility from an portfolio. Utility function and indifference curve continue. Indifference curve represent the different combination of risk and return which provides the same level of utility to the investor. An investor is indifferent between any two combination, any portfolio that lies on the same indifference curve. Very steep indifference curve indicates that an individual has higher tolerance for risk. Flat indifference curve belongs to a highly risk averse investor. If the risk tolerance is high, means the investor is risk seeker. That is the high, very steep indifference curve. For the flat indifference curve, it belongs to the risk averse investor. The optimal portfolio offers the greatest amount of utility to the individual investor, where the utility will be high or the greatest, that is the optimum portfolio, and that portfolio is being selected under the Markowitz theory. These are the risk seeker investor. Here is the risk, that is the return. Risk seeker investor always want to increase the return. They want to increase the return like this, whereas these are the risk neutral. They are neutral about risk and return. Whatever risk and return they are getting, they are neutral with that. They do not know what is risk and return. They do not know what to do with the investment. They are simply having the ample amount, a large amount of money, and want to make the investment. They are the risk neutral investor. And the last is the most important, and the most of the investors are risk averse investor, who always want to reduce the risk. They are the risk appetite. They are aversion to risk. They always want to reduce the risk at any cost, whereas risk seekers always want to increase the return at any amount of risk. So, in sum, if we are analyzing risk as a utility function, then these are the risk seeking investor, these are the risk averse investor, and in between which shows a angle of 45 degree, these are the risk neutral investors. So, utility function, these are the three kind of investors which we are having. Under the utility function and indifference curve, say for example, this is the indifference curve, this is called as the indifference curve family, indifference map, where there are various combination of indifference curve. Under a single indifference curve, say for example C1, under the C1 there is a portfolio S1 and S2, these both are the portfolio, these both are the portfolio, and this is the indifference curve 1. For the indifference curve 2, S3, S4, these are the portfolio. For the indifference curve C3, there are two portfolio S5 and S6. For each indifference curve, investor is indifferent with the risk and return, whether he can invest at this point or at this point. The investor will be indifferent with the utility, means the utility for the investor in making the investment in S1 or S2 will be same. So, this is the called as the indifference curve. Under the feasible set of portfolio combination, in a real world investment universe with all of the investment alternatives like stocks, bonds, money market instruments, money securities, hybrid instruments, gold investment, real estate, etc. It is possible to construct many different alternative portfolio out of risky securities. And these feasible set of securities, these feasible set of portfolio combination are made with the help of utility function, which we have discussed in our graph. Here the utility of the investor is same whether to invest in portfolio S3 or S4 under the indifference curve C2. The utility of the investor is same whether to invest in S5 or S6 under indifference curve C3. These indifference curve are made or constructed based on the risk and return characteristics of an individual investor. An individual investor can make the investment at any point and he is indifferent. If that investor is moving towards this, he feel more satisfied. If he is moving towards this, he feel still more satisfied, because at this point the risk level is same, but the return level is high. So, this C3 indifference curve, investor always prefer these kind of indifference curve, where under the C3 the investor will be more satisfied, the utility will be highest under C3, but the investor is indifferent by making the investment in S5 or S6. It decided the utility function of an investor under the indifference curve. So, feasible set of portfolio combination, each portfolio will have its own unique expected return and risk, and wherever you construct a portfolio, you can measure two fundamental characteristics of a portfolio, and that characteristics are portfolio expected return and portfolio risk, which is being denoted by alpha. Feasible set of portfolio combination, say we may take the example of startup with the random assembling of 10 risky portfolio. We are assembling a 10 risky portfolio, and by calculating the risk and return, we are plotting them on a graph based on the expected return and risk profile. Say these are the feasible set of portfolio, 10 achievable risk portfolio combination. Here is the expected return, here is the expected risk. This portfolio risk is calculated by alpha, and this calculated by SD, and this is the expected return from the portfolio, and these are the possible combinations, 10 achievable set of portfolio. These are the various portfolio, portfolio 1, portfolio 2, 3, 4, 5, 6, 7, 8, 9, 10. These are the various sets of portfolio having different risk return characteristics. So, here we are taking the example of 10 sets of portfolio. If we are increasing these portfolio to 30, Let us take, you could have a continual random sampling of mode portfolio. 30 risky portfolio might look like this. These are the 30 risky portfolio combinations, expected return and expected risk. Under the Markowitz theory, we are putting these risky portfolio under the expected return and risk graph by putting the expected portfolio of having a different risk return pattern. If we are combining hundreds of portfolios, like when you construct many hundreds of different portfolios, namely varying the weight of individual assets and the number of types of assets themselves, you get a set of achievable portfolio combinations as indicated on the following slide, like this. These are the 100 sets of portfolio, achievable sets of risky portfolio combinations. These are the expected return, this is the risk, portfolio risk. This E is the minimum variance portfolio. This is the minimum variance portfolio and this is the highest variance portfolio, and these are the upper side, this upper side. Again this red, by combining these red, these are the highlighted portfolios are efficient. Highlighted portfolios are efficient in that they offer the highest rate of return for a given level of risk. Rational investor always prefer the higher rate of return at a optimum level of risk. So, these are the, this is the higher efficient portfolio, because take the example of this. Under this, the return is high, but the risk level is same. Risk level is same, where this should not be accepted. Only this portfolio should be accepted, because at the same amount of risk, the return is highest. If we are going for this, the same amount of risk, the return is higher. So, with the help of this, we can, this is the highlighted point, the red colored point are the highlighted point of portfolio which are treated as the efficient or optimum risk portfolio. Efficient portfolio means efficient combination where the risk is low and return is high. Where the risk is low at a given level of return, or the return is high at a given level of risk. E is the minimum variance of portfolio. Efficient frontier. So, this constitute an efficient frontier. This constitute, by combining this red, this constitute an efficient frontier. The efficient frontier consists of the set portfolios that has the maximum expected return for a given risk level. The leftmost boundary, this is the leftmost boundary, this is the leftmost boundary and this is the rightmost boundary. The leftmost boundary of the feasible set of portfolio that include all efficient portfolio, they providing the best attainable trade-off between risk and return. As I have told you, attainable trade-off, best attainable trade-off like this, attainable trade-off, highest return low at the same level of risk, at a given level of risk. So, portfolio that fall to the right of the efficient frontier are not desirable, because their risk and return trade-off are inferior. Means under the left hand side, under the right hand side of the portfolio, like this, the right hand side, these are the right hand side, these are not the efficient one, because they are having a higher amount of risk at a lower amount of return. They are given a higher amount of risk at a lower amount of return. So, their risk and return is not being trade off. So, the portfolio that fall in the right of the efficient frontier are not desirable, because their risk return trade off are inferior. Portfolio that fall to the left of the efficient frontier are not available for the investment. Under the left of the these are the left side. Here the portfolios are not available, these are not available, not available. If these would be available, then definitely it could be the optimum investment, it could be the optimum investment pattern. Efficient frontier in a feasible portfolio. If we construct the efficient frontier, so by combining all the red mark, we are able to construct the efficient frontier, and this efficient frontier is the efficient set of achievable portfolio combinations that offer the highest rate of return for a given level of risk. At a same level of risk, the highest level of return is being decided, and this is called as the efficient frontier. By combining all the red mark under the given sets of hundreds of portfolios. So, by combining the efficient frontier and utility curve to get the optimal portfolio, the portfolio that lies at the point of tangency between the efficient frontier and her utility curve, indifference curve. An investor optimal portfolio is the efficient portfolio that yield the highest utility, which gives the highest utility to the investor is called as the optimum portfolio, and the risk averse investor has the steep utility curve. And these are the three combination set of indifference curve under the utility approach under the Markowitz theory. As most of the investors are the risk averse investors, they always want to reduce the risk at a given level of return, hence they always prefer a steep utility curve. Second, an investor optimal portfolio is the efficient portfolio that yield the highest utility. The investor always prefer that portfolio which gives that efficient portfolio which gives the highest utility, and highest utility always talk about where the indifference curve will be highest from C1 to C3. Let us have again look. These are the highest utility, C1 to C2 to C3. So, once an investor is moving from C1 to C2, C2 to C3, this C3 is the portfolio combination where the utility will be highest for the investor, but the portfolio lies under this utility will be the investor will be indifferent on this utility function, whether he or she can invest at this point, this point, this point, at any of the point the investor would be indifferent. So, and the optimal portfolio that lies at the point of tangency between the efficient frontier and the utility indifference curve. Now, we are making the utility function indifference curve as well as the efficient frontier in combined. This is the optimal portfolio construction. Here the utility is being increasing L1 to L2 to L3. These are the three utility L1, utility L2, utility L3. This is the increasing utility. Investor always prefer to invest in those kind of stocks whose utility is in the increasing trend, as the investor is always be a risk averse investor. Most of the investors are the risk averse investor. Under this utility, once we construct the efficient frontier, this efficient frontier constitute BYOZC, BYOZC, BYOZC. Once we find out these are the efficient frontier, these are the portfolio combination come under the efficient frontier, efficient frontier. Once we are drawing, we are putting the efficient frontier with the indifference curve, then we are the point of intersection of efficient frontier with the indifference curve is the point of optimal portfolio. Optimal portfolio is the point where utility will be optimum, risk and return will be optimum. Risk and return we have find out with the help of efficient frontier, utility we have find out with the help of indifference curve. Investor will not move towards the L3, investor will not move towards the I3, but investor will be stick with the I2 because efficient frontier will lies under I2 under the O point. So, this intersection point will be treated as the optimum portfolio. This feasible or attainable set of shaded area. These shaded area are the various attainable set. These shaded area are the various attainable sets where the investor can make the investment, but investor always make the investment in that kind of portfolio which gives the highest utility, as well as which can establish a trade off between the risk and return. So, with the help of risk and return trade off and the highest utility function, highest utility with the risk return trade off, investor can develop an optimal portfolio with the help of efficient frontier and utility function. So, here is the portfolio risk, here is the portfolio return. I think we have sum up with this. One of the major point under this Markowitz theory is this: investors are risk averse investors. Investors always prefer the higher utility portfolio. Investor is indifferent to a single indifference curve, whether to invest at any point of indifference curve. And the last and not the least, the investor always prefer higher return to lower return portfolio and lower risk to higher risk portfolio. Means investor always want to establish a trade off between risk and return. Lower risk securities like a post office investment, right. If we are moving towards higher risk, then it can be go up to real estate, then again go up to stock market, then gold. So, there are various category of risk where the investor are making the investment. Investor are making the investment based on the various risk and return profile. So, under the lower risk to higher risk movement, investor always move towards lower risk securities to higher risk securities, and once we are talking about the return, investor move towards higher return to lower return security, so that the efficient frontier can be constructed. Efficient frontier is the combination set of efficient set of optimum portfolio under the attainable sets of portfolio. Once this efficient frontier intersect the indifference curve, and which is called as the utility curve, and that intersection point is called as the optimal portfolio which an investor should select. There are few of the limitations under this model. This model is a complex model involving tough calculations for an n number of securities, n net returns, n variances or n covariances, because there are ample number of portfolios are included, and each and every portfolio are including n number of securities. Once we are having, for an example, once we have constructed a portfolio efficient frontier, we have combined hundreds of portfolio. We have combined for constructing an efficient portfolio, we have combined the hundreds of portfolios, and each portfolio consists of number of diversified various risk and return characteristic securities, various securities. So, for constructing the 100 portfolios, for developing the 100 sets of portfolio, we have to combine thousands of securities, and analyzing the thousands of securities is not an easy task. So, this is the most important limitation of this model is it is not easy to calculate. It is very tough, because number of securities lies under this theory is very large. Number of investment avenues lies in this theory are very large. So, it is not an easy task. So, this is the first limitation. Second is exact estimation of investors risk tolerance is not easy to task, because investor risk tolerance is the psychological state. For the same kind of security, for a same amount of investment, the risk tolerance between two investors are different, because as I have told you in my previous lectures, risk is also a negative or psychological state of mind, where the risk tolerance is also differ, which is also based on the demographic factors of a particular investor, like the age, the responsibility undertaken by the investor, the income level of the investor. So, these are the various things which decided the risk tolerance power of the investor. If the risk tolerance power of the investor is very high, it means that investor are risk seeker, and risk tolerance power is not very high in most of the investor in today's area, in today's arena. So, we may say the exact estimation of investor risk tolerance is not an easy task. It is behavioral aspect, it is qualitative aspect. So, it is not an easy task, and revision if required. If the revision can required under this portfolio, it is not an easy, because already once we are constructing the portfolio, selecting the optimal portfolio with the help of optimal portfolio theory, with the help of Markowitz theory under the efficient frontier and indifference curve, we have included thousands of securities to analyze. Once we have analyzed and now we want to revise our portfolio, it is not easy. Again, analyzing the thousands of securities from a very first point. So, it is not a revision of portfolio is not easy. Hence, these are the basic limitations and the most difficult limitations under this model, where the n number of securities and these kind of limitation are only arises due to the number of securities lies for analysis. The scope of securities, the span of securities lies for analysis to construct a portfolio is very large, and as the large number of securities are included, henceforth the portfolio construction is not easy, and once the portfolio is constructed on not giving the optimum return, then definitely the revision will not be easy. So, this Markowitz theory is related with the modern portfolio theory, modern concept of portfolio selection, where a particular individual investor, based on the statistical measures like risk and return appetite attached with the particular portfolio. Based on the risk and return measures, based on the statistical figures of risk and return, an investor Markowitz efficient frontier is being constructed, and under the efficient frontier indifference curve intersection point, optimal portfolio is being selected. So, the reference I have taken from the Nagarjuna, J. Jaibal, G, and Security Analysis and Portfolio Management, New Age International Publisher, and Donald L. Fisher and Ronald L. Jordan, Security Analysis and Portfolio Management from Pearson Education, 6th edition. One thing under this portfolio efficient frontier theory, or we may say Markowitz theory, most important thing is once we are selecting the optimal portfolio at O point, then we have to leave all the portfolio under consideration. It might be possible, say for example, I have told you the limitation of revision of portfolio not easy, but once we have to go for revision, then we may again go for revision under the alternative of Y, B, Z and C. So, that the revision might quite easy, becomes easy, but not so easy. So, thank you very much. With this, I think we have learned about how we can construct our portfolio under Markowitz theory. Thank you very much.